SpaceX IPO. How is your retirement account being used? Elon Musk is preparing the biggest IPO in human history. You heard that right, friend. Today I'm going to talk to you about a turning point in financial history. And no, this is not your ordinary stock market news. Let me give you the number. $1.75 trillion. A company entering the stock market at this valuation leaves the entire American defense industry behind in a single line item. Put Coca-Cola, McDonald's, Nike, Disney, and Starbucks in one bag, still not enough. Line up the 10 biggest companies on the London Stock Exchange side by side, the total still can't reach the same number. And this company lost $5 billion last year. So who is buying this? You. Within a few weeks, your retirement account, whether you know it or not, is about to become one of the largest buyers of this company's shares. If you want to understand how that's even possible, we need to go back a little. Because there is a deep gap between what people think they know about SpaceX and what is actually going on. If you ask someone on the street, what does SpaceX sell? They'll most likely say rockets. Maybe they'll mention something about Mars. Neither is completely wrong, but neither is completely right either. SpaceX is not actually a single company. It's a structure where 3 completely different business lines operate under the same roof. And each of those 3 lines tells a very different story. Let's start with the first one, because it's the most talked about and the least profitable. xAI. The artificial intelligence company Elon Musk founded in 2023 to compete with OpenAI and Anthropic. Earlier this year, SpaceX absorbed xAI through a share swap deal. Valuation: $250 billion. This is the point where you need to stop and take a breath. When xAI was founded, it had genuine heavyweights from DeepMind, Google, and OpenAI by its side. 11 co-founders. By early 2025, all 11 of those names had left the company. Elon Musk himself announced on his own platform that the company needed to be rebuilt from the ground up. Now compare the numbers I gave you. OpenAI generates $24 billion in annual revenue, valued at $850 billion. Anthropic generates $30 billion, valued at $400 billion. xAI's estimated annual revenue is around $1 billion. Valuation: $250 billion. So the market is pricing xAI like an Emirates ticket. But when you walk through the door, Spirit Airlines is waiting for you. This business line is burning through roughly $1 billion every month. And it's now sitting inside SpaceX's balance sheet. The second business line is the rocket side. Satellite launches, cargo and crew missions for NASA, military payloads. It generated around $4 billion in revenue last year. That number sounds good. Until you look at what share it represents of the company's total revenue. The rocket business accounts for only a quarter of SpaceX's total revenue. The real weight is somewhere else. The third business line. This is SpaceX's real engine. Starlink. Internet service delivered via satellite. Mount a small antenna on your roof, and satellites orbiting above send you internet. It sounds simple, but the engineering behind it is extraordinarily complex. It entered beta in 2020. 6 years later, it holds the title of the fastest-growing telecommunications company in human history. Over 10 million active subscribers across 150 countries. More than 10,000 satellites in orbit. This is genuinely something incredible, man. In 2025, Starlink alone generated $11.4 billion in revenue. That's more than 61% of SpaceX's total revenue for that year. But what impresses me most isn't the revenue, it's the efficiency underneath it. 2 years ago, the profit margin was around 41%. This year it climbed to 63%. More than 20 points of margin expansion in just 2 years. Alongside the consumer version, Starlink has a maritime version and an aviation version. And there's a classified defense arm called Starshield, with active contracts with the Office of the Director of National Intelligence and the Pentagon. So the real picture of SpaceX looks like this: a cash-generating satellite internet company, a reasonably growing rocket arm, and an artificial intelligence company burning through $1 billion every month. Put those three together and you get nearly $5 billion in losses on $18.5 billion of revenue last year. And this loss-making structure is preparing to go public at the highest valuation in history. So how? This is where the real story begins. It's not about rockets. It's not about satellites. It's about a rule change. On May 1st of this year, Nasdaq quietly rolled out a new framework called the Fast Entry Rule. Given that SpaceX is reported to be targeting June, the timing is remarkably convenient. You know, the Nasdaq 100, the most prestigious index for technology and growth companies. Getting into this index means every investment product tracking it, representing over $600 billion, is required to automatically buy that stock. Under the old rules, a newly listed company had to wait at least 3 months before being added to this index. That waiting period existed for a reason: to give the market time to discover the real price. To let the price settle before passive funds started buying automatically. The new rule cut that window from 3 months down to 15 trading days. There was also a free float requirement. To enter the index, at least 10% of a company's market cap had to consist of publicly tradable shares. SpaceX is targeting a free float of somewhere between 4 and 5%. Under the old rules, that figure was an automatic disqualifier. Under the new rules, that requirement has been completely removed. And then there's a hidden multiplier, a detail buried inside the technical documentation. For companies whose free float is below 20%, Nasdaq counts that float as 3 times larger than it actually is. So a 4% float gets treated as 12% in the index calculation. To summarize, the listing requirements changed, the waiting period was shortened, and an artificial weighting multiplier was added. All at the same time. All right before SpaceX's IPO. And this isn't just for SpaceX. OpenAI and Anthropic are also reported to be planning IPOs this year. Both will almost certainly be listed under the same configuration. Nasdaq didn't rewrite the rules for a single company. It rewrote them for a class of companies. There's also the retail side of things. In a standard IPO, individual investors are typically allocated somewhere between 5 and 10% of shares. SpaceX is targeting 30%. SpaceX's CFO, speaking in front of a room full of bankers, put it this way: retail investors have shown incredible support for Elon and this company for a long time, and we want to appreciate that. Let me translate that from financial language. We want to sell 30% of our shares to buyers selected on the basis of loyalty, not price. Here's how the story plays out. There are insiders sitting on shares acquired at low cost. There are passive index funds that will buy automatically. Individual investors, retirement accounts, and ETFs fill the gap in between. Shares flow from early buyers to late buyers. Portfolio manager George Noble put it in one sentence: your 401k is their exit liquidity. So if you have any retirement account linked to a U.S. equity index fund, you will own some of these shares within a few weeks of SpaceX's IPO. You won't choose this. You won't be asked. The mechanics of passive investing will make this decision for you. Passive investing was sold to you like this: low fees, broad diversification, the ordinary person's victory over expert stock pickers. All of that is true. If you want to better understand what's happening in finance and economics, subscribe. Because there is one thing I can guarantee you. But here's the side nobody mentions. The same mechanism that automatically buys the index for you also automatically buys everything that gets added to the index. For anyone who understands the system and has the budget to work it, getting onto the index list means creating a guaranteed pool of buyers. And right now, someone is in the middle of adding a new name to that pool.